Hello, and thanks for tuning in to the Australian Investors Podcast, a series exploring the investment philosophies and journeys of some of Australia's leading investors and financial thinkers. I'm Owen Raskovich, founder of the Rask Group. For show notes and other episodes in this series, as well as free educational resources, please visit www.raskfinance.com. Before we go on, it's important to remember the Australian Investors Podcast is provided for educational purposes only and should not be relied upon to make an investment, financial, or taxation decision. The information included in this podcast does not take into account your needs, goals, or objectives, and guests appearing on the show may have a financial interest in some of the products mentioned. Please read all the important disclosure documents and refer to the Rask Group's Financial Services Guide on the Rask Finance website. In this episode, I chat with Robin Bowerman, the Head of Corporate Affairs at Vanguard Australia. Robin is a former journalist, an author, and has been with Vanguard since 2003. Globally, Vanguard is the world leader in low-cost index funds and exchange-traded funds, or ETFs. It has changed the world of finance for almost every Australian, whether we choose to admit it or not. Therefore, I think some of the talking points in this episode should be heard and understood by investors of all stripes. Robin and I talk about his journey, common failures by smart investors, culture at Vanguard, why almost all active funds underperform over many years, and the prospects for index investing going forward. We start with Robin's journey long before he started at Vanguard.
Yes, a bit of an unusual background probably for someone in funds management these days, but I started out as a journalist, cadet journalist on the Hobart Mercury many moons ago. Basically, my first exposure in the sort of investing world was literally walking around to the Hobart Stock Exchange and picking up the quotes at the end of each day and going back and trying to make some sort of article out of that. And then my real introduction, I guess, to investing was probably one of the, I don't know whether they still do it, but the ASX used to run education seminars. Mm-hmm. So I went along to one of those seminars that was run introducing people to the share market. Because the share market was not something I grew up with. My parents were not share investors. Much more sort of in the small business, term deposit sort of world. So that opened a whole world of opportunity and risk, as we found out. But yeah, that was sort of the part of that sort of journey, I guess, into that, and then a bit of studying around economics. Where I was quite interested and sort of followed up through the journalism.
So there was no financial coverage from your journalism role. There was what were you covering?
No, I was in fact I was covering politics and general news, everything that would happen in a small regional sort of metropolitan newspaper. So no, the exposure to business journalism as opposed to investing journalism really came when I worked on the Sydney Morning Herald. And I went from the general news area into the business desk for a couple of years, and then ended up in London on the Financial Times, which obviously was pretty focused on business stuff. So the business piece really was where I sort of bridged from general journalism into the world of business and sort of money. And then when I returned to Australia with my wife, was lucky enough to get a job with Bob Gottliebson and David Koch and Ross Greenwood on BOW Personal Investor. So, and that's when I really became passionate about the sort of personal money stuff, because I realised this is actually how you could link journalism and help educate people, share stories of real world investors and what real people were doing as opposed to the theory.
Okay, so this was the magazine?
Yep, yeah, it was Personal Investor.
Yeah, and how many people was this going to?
At its peak, it was going to well over 100,000 people a month.
Great.
So no, it had pretty strong coverage. I mean, it's back in the days before the internet. That's how long ago it was. So it was part of it had the ASX monthly tables, which a lot of some of your older listeners might still remember. You used to get the ASX journal each month and go through and look up every stock and what was on offer and all the different dividend rates, etc., etc. So it was a huge amount of data. It was like 30 odd pages of I think 7-point data or something.
Wow.
It was pretty. It was the Bible in terms of ASX data at that point, apart from what you got on the radio or TV news.
Yeah, great. So people pick this up and then call their broker and execute a trade.
Yep, absolutely.
Okay, great. So the next stage of your career is of a lot of interest to me. Or I suppose this, correct me if I'm wrong, happened when you were at Fairfax, and you decided to write a book. And the book was A Wealth of Experience, Investors Share Their Secrets. Can you tell us more about this, why you wrote it, perhaps who you wrote it with and what you found?
Sure, yeah. I mean, to be frank, it happened by accident. Jeremy Duffield was the managing director of Vanguard, who I'd met a couple of times as a journalist. And we were at a Australian Investors Association conference on the Gold Coast, and he literally bumped into me outside one of the presentation rooms and said, just said, "What are you doing?" And I said, "Well, I'm thinking about coming along to your session on, the greatest mistakes investors make." And he said, "Well, that's good, because I haven't really prepared any presentation per se. I'm hoping people will share their stories." But he said, "But if no one will, then this is going to be a very short and dull presentation. So can you come in and perhaps, use your journalistic skills, share a bit or ask a few questions, and we can try and get the audience involved and see how we go."
So you passed around the mic and...
Yep, so we had a couple of roving mics, and we had a couple hundred people in the room, I think, and we needn't have worried, or he needn't have worried, because we sort of set the scene about, people prepared to share not their most successful investing stories, but their mistakes, where they'd really done something dumb in hindsight. And people were almost fighting for the microphone to share, weird and wonderful ways that they'd managed to lose money, everything from exotic agricultural tax deduction schemes to Vanuatu tax shelters. There's a couple of the more weird ones that I remember. But in essence, these were a bunch of, they were at the Australian Investors Association conference, so they were clearly people who were very engaged with investing and probably pretty successful in their business lives, etc., and comfortable in their own skin. So they were very comfortable sort of sharing, some of the great stuff-ups they'd made along the way in the interest of helping other people. And so we realised at the end of it that there was a rich vein of sort of material here, and fantastic if we could share those sort of mistakes and real world learning. Because these are not silly people usually; these are people who've made some pretty fundamental errors. So the long story short was we went back to the conference next year, but that time we went with proper recording equipment.
Okay.
But this time we did it as a full plenary session. There were 400 or 500 people. And so we were a lot more disciplined about gathering the data and the stories that people went. And then all we had to do was sit down and write the book, which, I spent a fair bit of a long summer holiday sort of compiling it with Jeremy and locking ourselves away for days at a time to pull it together. And the book came out as I think a pretty good read for people to let people know that, there's lots of things which perhaps people find ways to lose money which are not that silly. They're actually just fundamental errors and basic mistakes. Things like, when share markets are running really high, that's the time when people get greedy and they want to get in, versus the time when the share markets come off 20 or 30% and people are running to the exits. The sort of thing where you're basically buying in when the market's high and selling out when it's low. So just some fundamental timing sort of issues, and some of the lessons we took out of that were actually really, I think, pretty useful. Certainly the feedback we got around from the book was pretty good, and certainly people today still occasionally call me up and talk about it.
I think it's about 180 pages in total.
It's not a hard read.
No, okay. Well, I encourage people to give it a read. I was trying to find a copy myself. Where's the best place to... Can you still get it?
I actually don't think it's still in print. I think it was reprinted a couple of times, but we can perhaps check that out, and maybe we can put up a version or somewhere on the website for people to
that'd be
look
great.
at.
Yeah, definitely we will. How did you filter through? Were you just looking for the clangers, the worst mistakes, or...?
Well, we had so much material to work for. The real challenge was actually so it was really around categorising it and bringing it down to, where people make common mistakes. So particularly things like around trying to market time, the making investment decisions based on tax outcomes as opposed to investment outcomes, for example. A lot of the people in the audience were medical practitioners. And I don't know what it is about doctors and lawyers, but they seem very focused on tax.
Something to do with their incomes.
possibly do something like they don't get enough deductions. But anyway, that they are very focused on tax, so they were very susceptible, it seemed, to the latest sort of agricultural tax scheme, the trees, these sorts of things seem to have an immense amount of appeal, forgetting the fact that as an investment they were a complete dud most of the time and lost money. But the tax deduction was the thing which really influenced them. So it was things like that we look for, and also trying to, the book was probably at the early stages of when I was getting interested and trying to learn more about investor behaviour. So here we had a bit of a sample of groups of pretty sophisticated, generally reasonably well-off investors, and what sort of behaviours were common across those sorts of groups. And I think the study of behavioural finance is really pretty young. It's probably 30 years old, and I think we've learned a lot more that investing's not about just the data, not just the performance numbers. It's actually about things that as human beings we're wired to do. I mean, the bottom line is, as human beings, we're not well wired to be investors. Our emotions can take over. Fear, flight can actually overrule things like rational thought. So, the economists, the pure economists sort of, work on the assumption that everyone acts rationally, and the reality is that the reverse is actually the true. And people like, Richard Thaler and Daniel Kahneman, I think, have done amazingly good work at showing that, there's so much more that goes on in the investor's mind, whether it's listening to podcasts, whether it's listening to TV, watching the internet. And sometimes the hardest thing to do can be to tune out the noise. When you turn on, on your phone, the TV news every night, and you're being bombarded with information, it sort of screams at people to do something. Where often in investing, the best piece of advice you can get is do nothing. Set it up, leave it alone, go away. And that's we're not wired to do that.
Yeah, it's interesting. One of my favourite business writers, Morgan Housel, says 99% of long-term investing is doing nothing, but it's the other 1% that changes your life. This point in your career, I suppose, these early learnings, I'm interested to know why, at the time of writing this book and presumably having quite a successful career in journalism, you decided to step over the fence and join Vanguard in 2003.
Sure. I mean, there was a few factors at work there. One was that I'd been off at Stanford University and done a sort of digital media course, and I saw the potential impact of the internet, online world on traditional print journalism. So I guess I was in an environment which was very traditional print, and they were fairly slow. I think that obviously they were not wanting to cannibalise existing businesses, but so short story, a little bit of frustration built up around the ability to get into what I thought was going to be the future of journalism, which was very much sort of online world, and doing everything sort of digitally. The second piece, though, probably goes to the type of journalism that I was working in, which was I was the editor of Personal Investor, now Smart Investor. And, a lot of the sort of articles we're writing around that was about which hot stock tips there were this month, which fund manager was shooting the lights out, outperforming the index, etc. And I even created some of the Fund Manager of the Year awards, which are still running today, somewhat sadly, I think. But, those things were starting. And I just, not being the quickest or sharpest guy around, but it did over a period of years realise that, I write about these people who had done really, really well last year. When I look at what they've done a year later, and I started writing about how have the Fund Manager of the Year's gone 1, 3, 5 years after they won the award, and the answer was nearly always that they'd actually reverted back to the pack or worse. So the hot stock tips, which, again, back to investor behaviour, if we put a cover out in the magazine saying 10 hot stock tips for now, the magazine would sell would walk out the door. If we put a cover story out there saying 10 investment tips for the long term, or 10 things to do with your super, we'd hardly sell anything. You know, the circulation people hated me when I used to put that stuff on the cover. So it was sort of realising that actually, you know, maybe some of the journalism we were practicing in the personal investor days wasn't actually helping people. That what was really, was actually hurting them, because it was actually encouraging them to trade short term. And the more you trade, the less typically you'll make, etc. Despite the fact that the people being talked about, you know, we interviewed were smart, very professional, working really hard. That it wasn't that there was anything there. It was more just that it just showed me how hard it was to outperform the markets. About the same time, Jeremy Duffield again invited me to MC a function. Vanguard was launching its retail business in Australia, and he brought out Vanguard's founder, Jack Bogle, on his one and only trip to Australia. So at a couple of functions in Melbourne and Sydney, I got to obviously travel and, you know, meet Jack, talk to him over breakfast.
Wonderful.
And MC this event with him. And I've got to say, he was a truly sort of inspirational character, probably one of the great investment thinkers of the century.
Absolutely.
And that was a bit of an epiphany for me in terms of, you know what, maybe we've all been wasting our time trying to outperform the market. What we just need to do is what Jack says, which is buy the market. So I probably began to become a convert to the idea of indexing as, you know, the smart way for average people like me to actually invest long-term money and let markets and the sort of company and the profit growth actually, build the wealth, as opposed to me trying to outsmart everyone else who's trying to outsmart me.
I can imagine it would have been wonderful being joint MC or sharing the stage with Jack Bogle. That's actually a great segue into the next line of thought and, I suppose, life here at Vanguard. Can you tell us a little bit more about how Vanguard began and what its mission was in the early days?
Yes, well, again, back to Jack. I mean, he set the business up. He set it up unusually as a mutual, so it's so the people who are the investors are also the shareholders in the US business.
Okay.
So it effectively runs as an at cost. So it's not listed on Wall Street. It's not a private company that's making a lot of money for, you know, shareholders. The shareholders and the investors sort of one and the same. So it may feel like a slightly technical, structural issue, but I fundamentally believe it drives a lot of the behaviour and a lot of the culture at Vanguard, and it's actually what's made us successful today, where it's gone from a very small, experimental startup, you know, with about $12 million or something. I think they had to invest the first time they floated, to today, which is, you know, over $5 trillion within about 20 million investors worldwide. And in Australia, we look after, or we're entrusted to look after, about 140 billion of Australian investors' money, either through institutional super funds or through advisors or through self-managed super funds using ETFs, etc. So, you know, heavy sort of responsibility to actually look after that sort of money. So Vanguard started with a very simple idea that rather than try and beat the market, we would, Jack Bogle launched the first retail index fund, and the rest, as I say, is history. But it took a long time to be successful. You know, it's taken nearly 40 years to get to that level of success. And then Jeremy Duffield, who was a Melbourne boy but was working in the US, did an economics degree in the US, and then went to work for Jack Bogle and worked with him over there for about, I think, 15 years, and then wanted to come home to Australia. So he came back and set up Vanguard in Australia here, 22 years ago now. Then, you know, built the business both in institutional, sort of retail, advisor space, etc. And I guess the great good fortune on my part was having met Jeremy a number of times. He eventually invited me to apply for the job as Vanguard as the head of the retail business 15 years ago now.
It's hard to believe, I think, that the Australian arm has been around just over 2 decades.
Yeah.
And in that time there's been explosive growth, I think you could say. I'm interested to learn more about the structure and how I suppose, in more granular detail, how you think that has emanated through the organisation and into the culture, perhaps even towards the incentives and what drives people day to day at Vanguard. I often meet with fund managers who reward their staff quite handsomely with equity or cash bonuses for good performance or share ideas in the portfolio. But obviously that's flipped on its head here in the sense that it's about understanding the things that you can control as an investor and delivering those outcomes. So I'm interested in your thoughts on that.
Yeah, no, I mean, I think I don't think there's any great secret to it. I mean, a part of it is, the mission that Vanguard launched with was to, as I said, launch the index funds. So obviously the job there is to track the index as tightly as you can. If you're paying away a lot of money in distribution fees to commissions to advisors or bonuses and these sorts of things, then you're going to underperform the index pretty dramatically. So first point is keep the costs as low as possible. And I think Bogle was an absolute evangelist for low cost investing. And I think that it fundamentally drives a lot of what we do. I mean, we had never paid for distribution around the world, so we don't pay commissions to salespeople to sell our product. And when we first opened the doors in Australia, that was a challenge because a lot of the advisors here were used to receiving product fees and commissions, etc. So, part of the success of Vanguard has been driven by the tailwinds of regulatory reform, which is, when the ban came in on conflicted remuneration post the future financial advice reforms, post GFC, post storm collapse. I think a lot of advisors realised that those sorts of payments were, distorting investment decisions, and they were actually in the interest of the advisor, not the interest of the investor.
They were, yeah.
So, and again, we're seeing a little bit more of it play out in the Royal Commission. That's sort of ongoing at the moment, so I think we'll end up with more of that. But I think we've certainly seen in Vanguard, we've seen the growth in the number of advisors using Vanguard has grown exponentially because they've moved to being, instead of being sort of product salespeople taking a commission, they've actually moved into the world of asset allocation, portfolio construction, building core satellite portfolios, and just looking at what's the best portfolio for the investor. And advice should be paid for. It can be valuable. So, but just don't hide the value of advice and wrap it up in product fees, which the investor ultimately doesn't really understand actually paying anyway. So I think that's a huge part of what we do. I think the other point is that, as investors, what can you control, what can't you control? You can't control future performance. All the products carry the same warning label. Most investors continue to ignore it. Past performance still sells very effectively, let me tell you. But the point is you cannot control what the performance will be in the thing. What you can control, though, is how much you're going to pay for it. So, focus on things you can control. Cost is one of those, big one. Vanguard is not, we're strong advocates for index investing, but we have $1 trillion invested actively. We've got a good active management business. What makes our active business different to a lot of other active managers? It's low cost. It gives our fund managers a head start because they don't have as much, lead in the saddlebags to actually outperform before they actually get there. So it's been, a long and, I think you use the term sort of very successful story, but it's taken a long time to get that message out there that, if you look at a lot of things, cost is really an overriding factor. So you keep costs down, don't pay away a lot of money in terms of commissions or product sales, and you will actually, by doing that, you'll give the investors the best chance they can have for success over the long term. And it's the discipline of actually sticking to the long term that's really the real challenge.
Indeed. That's a great point about that you make about the sales and obviously keeping costs low compound over many, many years. And I think I recently wrote a piece about the disruption caused by low-cost funds. When we think of disruption, we think of automated checkouts or Netflix versus Blockbuster type of thing. But the impact of lowering fees and obviously those commissions going by the wayside has been enormous for people. And chances are many Australians don't even realise this inside super. Like I said, the compounding effect of that until retirement can be incredible.
Yeah, no, absolutely. And super's a great example where, and we just released some research on our website about the difference in when you're retired, the difference in paying 150 basis points in fees versus 50 basis points, it is huge. It makes such a big difference particularly over periods 30, 40 years. So keeping costs down in superannuation funds is absolutely critical. And I think it's not to say that there's not a role for active management. There is. I mean, Australians are some of the most interested sort of direct share investors in the world. I mean, we've got a lot of direct share ownership, often due to the demutualisations of CommBank and AMP and stuff like that. But the result is there's a lot of people who own shares directly. So and that's a great way to be engaged. But the point is, you can actually spread the risk of a portfolio. The average portfolio's got 4 stocks on it. That is not there's a huge amount of risk embedded right there. By adding one index fund or one ETF, where you buy the whole market, or you buy the US market, or you buy the European market, you can help the return certainly, but the main thing is you lower that risk factor. So it's just about getting that sort of sense of balance right that actually makes such a huge difference to people, particularly through things like the GFC. People who had a balanced portfolio, which you got to say most of the superannuation funds, their default funds, are pretty well structured. But if you actually look at the good, balanced, diversified portfolio, yes, does it take a hit when the GFC comes along? Absolutely. Did it recover within a couple of years with contributions and earnings? Certainly. And for younger people, the GFC was like, what's that? It's just a small blip on a long-term graph these days. At the time, people thought it was the end of investing as we knew it.
It's interesting. We'll get to a bit more of how asset allocation and I suppose the weightings in portfolios can add value in a moment. But perhaps we can backpedal a moment and for some of the listeners, just explain to them exactly what passive investing is. And then I suppose we can talk about how Vanguard might deal with some of the events that are unfolding in the market at the moment.
Yes, so sure. So I mean, and I got to be honest, I dislike the term passive because it sort of implies we don't do anything. I mean, our investment guys, trust me, do a fair bit during the day to manage the portfolios. So index investing is really saying we accept the fact that we're what we want to do here is track the long-term growth of a market portfolio. So if you think about what's on the news every night, the ASX 200 index. So if you buy an index fund that tracks the ASX 200 or 300, then it will own all of those 200, 300 companies in the market cap weight of their size on the index within the market. So it's if you'll end up owning BHP, you'll own NAB, you'll own ANZ, all that stuff, right the way down through to the smaller stocks at the bottom end of the 200. And then as cash comes in, the portfolio is rebalanced around those weights. The index may change. Some companies may collapse, go broke. They go out of the index. That gets sold. Something else comes in. It'll get bought. But at the end of the day, what you're saying is the Australian share market, the Australian economy, will grow. We expect it would grow over the long term with company dividends and company share price. So what you're really doing is buying into the economic growth of the country, and that it's as simple as that. And as Jack Bogle says, trying to pick the winning stock, is NAB going to do better than ANZ or Westpac and whatever? That's trying to pick the needle in the haystack. How about we just buy the haystack and be done with it?
I'm interested to know how Vanguard, say, deals with corporate events or changes to the portfolio. I suppose some people might believe that somehow someone could get advance notice on what the market portfolio is going to buy when there's an index change, for example. Perhaps you could touch on those 2 points. So how changes happen and corporate events.
Yes, corporate events, good example where, we'll look at those and the portfolio team will make a valuation judgment about what's in the best interest of the investors and the portfolio. Share buybacks are a good example. I mean, we participate, we make decisions around each of those things as they come along. Mergers and acquisitions, the same. So, at the end of the day, what will drive us is what does the index look like post-event and what the weight of that is, and obviously the portfolio is adjusted. Part of the management of the portfolio and something that Vanguard has worked very hard over the years is we don't want to impact the market. You don't want to by our sort of action be pushing prices up or down. So one of the things that our portfolio managers try and do is be able to transact in the market without having marginal sort of effect or notable effect. So trading around some of these events, there's a variety of techniques that they use, and it may be that they're a good example is if, say, a company is floating and it's going to float and be a significant part of an index, pretty much from day one, then you could either wait until it joins the index at a certain point, or you could perhaps, as it comes in, buy some of the stock up or futures up on the way through. So there's lots of portfolio techniques that are all geared towards minimising the tracking error. So keeping the portfolio as close as we practically can to what the index number is and what the value of it is.
One of the interesting things that people may not know, some listeners may not know, is that many of the smaller index funds and ETFs that have come to market may not fully replicate the group of shares that are underlying the portfolio. Can you explain the idea and the concept of replication?
Yeah, so full replication would be, let's say, take the ASX 300 index that we run our fund to. It will own 297, 299 of the 300 stocks. So it basically owns each of those companies in the market cap weighting of the index. So that's what you would call full replication. If you look at other portfolios, now smaller funds that don't have the sort of assets to invest across a whole range will sample. Now that can be perfectly legitimate, and sometimes, particularly in say fixed income indexes where there could be 3,000 or 4,000 names, holding all of them. It's a constant decision between holding everything and holding enough to give you the effect of tracking the index without the transaction cost. Because at some point, the tail, the small, the 0 point something % holding causes you to transact, which is a cost. But it will have almost zero effect on the performance of the fund. So, the sampling side of it is both legitimate, but it's something that investors, who want to understand the technique that their fund's being managed to, should look at it, and should be well disclosed in sort of the documents about the fund.
Yeah, indeed. I think it's particularly prevalent in some of the smaller indexes in Australia, but simply because there are liquidity constraints there. I'd like to shift now to yours and Vanguard's investment philosophy, and you recently wrote a piece on LinkedIn, or I shouldn't say recently, it was actually in 2016, which I'll link to in the show notes, but it relates to the idea of active funds underperforming. Depending on the year, we can safely assume that around 60% of active funds will underperform the market index, and as time goes on, we typically see that percentage getting higher and higher. Author J.L. Collins from the US believes that 99% of active funds underperform a passive market index over 30 years. I'm interested to know why you believe active funds and active fund managers underperform.
Well, great question. I guess the fundamental reason we think active managers, in those sort of SPIVA type results and that underperform is down to cost. The fees makes it really, really hard to outperform. And I think what we typically see is some strong performance for in any 1 year. I can guarantee you there will be an active fund that will absolutely shoot the lights out. They will have made a call, and it will have paid off, and it will be based on really good research or intuition or whatever the reason, whatever thematic thing that people have picked up. Great, and it's paid off, and it's paid off spectacularly well. The problem is when you look at the same product 3 years, 4 years down the track, it typically will have reverted back to the average or below average or the median. So, from an investor's point of view, and I saw this in my journalism career with personal investors, you'd see people on this roller coaster ride where they would do spectacularly well, and everyone would be boasting about it in the golf club. And then, it'd go quiet for a year or two because it would have underperformed. And you just see it being repeated time and time again. It's fundamentally because it's really difficult to actually outperform the market over a long period of time. So that's why we don't think it's about saying that indexing is 100% of what you should do. It's actually how you combine indexing and active. There are some things where there's definitely a role for active funds management. For example, some people like to tilt their portfolio, retirees and SMSFs, for example, towards dividend yields. Well, that's any time you do something like that, it's a bet against the market cap weight of the market, but you're doing it for legitimate portfolio construction reasons. Again, back to an advisor, sort of helping work it out. What's your risk profile? What actually works for you? So you may want overseas exposure to tech companies. So an active technology fund may actually work for you. It really comes down to the individual preferences of the portfolio and the individual. But our argument is at least start with a core of really well diversified, low cost index funds, and then add the active satellites, if you like, that sort of reflect your either. If you think something's going to outperform, why wouldn't you go there? Take the bet, but just understand the bet you're taking is against the market, and often over the long term, those sorts of things tend not to play out.
I believe that for the majority of Australians, passive investing is certainly something that warrants their attention, and absolutely couldn't agree more. Interestingly, from the post that you put out, you also talked about the rapid flow of information and I suppose the competition for an analytical edge amongst this. There's many smart people in our industry, as you noted earlier on, and those, I suppose, edges, as I refer to them, typically can be competed away very quickly. I was also interested to know that, to see in the research from SPIVA that many small cap fund managers also underperform, which is typically where we see, there's perhaps some type of informational advantage, albeit very minor. But that was interesting anyway.
I think, one of the, you talked a bit about how things have changed and sort of, obviously the flow of information today is immeasurably faster than what it was 50 years ago. Talking about from carrier pigeon to sort of email until one of the greatest books I've ever read on investing was Charlie Ellis's book, Winning the Loser's Game. And, he talks about the fact that when he started as an active manager, that really, active management wasn't that hard because you were basically betting against, you had a lot of knowledge about the market. You were typically trading with people who were maybe doctors and lawyers who didn't really have, they were doing it as a hobby or whatever they were doing. And today, when you think about it, when people go into the market to invest and take a position, they're up against large institutions, unbelievably well-educated, hard-working people, massive amounts of computer horsepower and analytics and big data capability. So you've got to ask yourself, why, when you buy something, do you think you're smarter than the rest of the universe? Because that's really what you're saying. And from an active manager point of view, it gets hard because you have to, typically if they have a good idea, they're going to have to ride with it for a while because it won't be instantly successful. It could underperform for a year and then it could pay off or not. But, it takes a lot of discipline to actually be in that sort of active management world. So that's to us about, spread the bets, diversify the portfolio, understand what risk's actually within it. But people often talk about return. You hardly hear, when you do retail seminars, you hardly hear people talk about their risk profile. When you ask them the question, what's your risk profile, they nearly always say, I'm really conservative. And when you ask them what their portfolio is, they'll probably typically have 4 banks, a couple of miners, a couple of ETF. And that does not look like a conservative portfolio. So, it's about, investors taking on responsibility for themselves a bit and saying, I need to understand a bit about this. I need to understand what risk I've actually got in the portfolio, because ultimately no one cares about it or will be affected by it as much as they will.
That's great. That's a great point, and your point about the level of work that goes into making some of these active calls. I recently got a call from my brother-in-law who said to me that stuff about index funds and ETFs, it just makes sense. Why don't more people do it? And I got an email about the same time, which I'll quote here. It says, I started investing in Vanguard funds when I was 19 with just shy of $10,000 in savings, and I've been putting in regular amounts monthly. That pot has now swollen up to close to $450,000, which I think is not bad for a 30-year-old who came to this country as an international student. And I heard that and I thought that was fantastic. So I'll put the question to you, Robin. Why don't more people just use index strategies?
Well, I'm glad to hear about this very happy Vanguard customer. And yeah, I mean, when we actually publish on our website an interactive index chart where people can go in and pick times and dates and over 30 years of data live, they can actually, they can actually go back and one of the things about it is compare your own portfolio to what the market's done, because a lot of people, think they've actually done okay, either with their super or with their share investments. They actually haven't ever benchmarked it to the portfolio. So point one would be, take the emotion out, deal with the data. I think in terms of why haven't more people embraced it, typically the indexing market in Australia now is about 17-18%, we think, with superannuation funds and with individuals. So that means that there's 80+% being invested actively. So your point's a good one. I think something we think about quite a bit and certainly talk about with investors, but part of it is investing is, as we go through school and university, what's the fundamental thing we're taught is that basically if you work hard and you do more stuff, you'll be more successful. And then suddenly someone comes along and says, you know what, stop trying to buy and sell all these stocks, just buy the market and forget about it. Take the average. And we're not, I think it goes back to behavioural finance.
We're all better than average, right?
We're all, everyone. You ask people at Investor Seminar, put up your hand if you're a below average driver. Very few hands go up. So either they're a room of exceptional drivers or some people are kidding themselves. I think in the investing world, it's really hard to say to people, it just feels counterintuitive to say to people, you're actually better off taking the market average. Because actually, if you do that, you will be above average over the long term. You'll actually outperform, your number, sort of 60-70% of the active shop. So it's a little counterintuitive. We think, we've done a reasonable job at Vanguard trying to get the message out, the website, but we can certainly do more. But again, low cost. We don't have big marketing budgets. We don't, you don't see us on sort of television, etc. out there sort of doing a lot of stuff. But we try and help people understand it. But it is. Jack Bogle spent, I had the good fortune to catch up with him for a coffee a few months ago in the US, and he's now 90 odd, but still sharp as a tack. But he's still telling the same message that he was telling, when he was 40 years old. So it takes a long time to sink in. The idea of this zero-sum game, where we're all the market. If you think about us as investors, if you think every investor in Australia is the market. So by definition, half will outperform, half will underperform. Zero-sum game, right? It's very simple logic, but it's a really hard concept for people to get their head around the kind of investing. In reality, because of transaction costs and taxes, more than half of people will underperform because you've got to introduce the real-world drag of brokers' costs, transaction costs. So most people will underperform when you look at the market in totality. So that's why buying the index. That's why the sort of relentless rules of arithmetic tend to work over the long period of time. And we think the message is getting out there, but it's certainly not mainstream. Sort of everybody goes there as a default.
You mentioned 16 to 18%. Is that correct?
Yeah, indexing in Australia in the Australian marketplace.
Okay, so not just Vanguard, but.
No, including all the indexing shops. Where in the US it's probably more like it's getting towards 40%, and in Europe I think it's sort of mid-20s and rising.
So you think there's scope for Australia to move towards 40% or even higher?
Absolutely, yeah. I mean we think there's a lot of upside, or from our own business point of view, we still think there's huge amounts of growth in. We talked a little bit about sort of technology and stuff through this, but I'd argue that indexing has been a disruptive technology with investing. You mentioned Netflix and etc. We think about those as Amazon, in very disruptive sort of indexing itself. I think Bogle's invention, but the indexing has been, if you like, the sort of disruptive technology, and ETFs people tend to focus on ETFs as being, the exchange traded funds as being the sort of new disruptive thing. I'd argue that all ETFs do is give you an easier way to access indexing. Indexing is the underlying technology that's actually changed the way investors work. ETFs have simply been, it just makes it really simple to access.
Just the wrapper around the outside.
Yeah. Well, instead of having to fill in an 8-page application form and get a PDS and do all this sort of stuff, if you've already got a discount share brokerage, 2 clicks, $19, you're done, and you're dealt. It just makes it sort of democratised it in the sense that indexing is now available through that sort of share market platform.
You mentioned something earlier on about the active side of Vanguard, which perhaps many self-directed investors aren't aware of. You mentioned $1 trillion worldwide.
Most of which is in the US, has to be said. Okay. But we are launching some active products here, and we'll continue to build that out over the next few years.
I'm interested in getting your thoughts about what you mean, and perhaps some of the products that are coming to market here in Australia. From what I could tell, there's a low volatility and a value. So
minimum volatility, value, but even for some, I'd argue, our high yield index fund is in a sense active because it's people taking a tilt. There's a term called smart beta, but really it's about people picking a factor, whether it be yield or be value or be minimum volatility. Momentum, another one. So I think those sort of factors, which were really, if you went back a few years, were regarded as active investing. And I guess the growth of indexing has meant that those sorts of factors you can now get through, the same sort of approach, disciplined sort of quantitative approach, that applies to an index fund. So it allows you to buy a specific characteristic of the market. So if you want to overweight, so particularly for people in retiree mode, I think low volatility, minimum volatility type funds, which a lot of pension funds around the world are using, just as a way of sort of balancing the volatility in returns. So there's lots of ways I think that the market will continue to develop and mature and allow people to tailor portfolios. It doesn't matter whether it's a large institution or an SMSF. That they'll have these tools that they can pretty cost effectively use to balance portfolios and fundamentally manage their risk characteristics.
We touched on it earlier on balancing portfolios and potentially for retail investors having an investment plan, and how the purely passive and these active tilts, these funds and multi-assets, so bonds, can be used together in an effective portfolio.
Yes, I mean I think the idea of diversification is probably the one free kick we get as investors. By diversifying across, you can actually spread the risk. We tend to think that the starting point for any investor needs to be to have a well-diversified portfolio. Now, that's not an easy thing to do if you're trying to build it yourself out of individual securities, because you need to own, your stockbroker will love you, but only because of the transaction fees you're paying. So that's where sort of pooled vehicles like managed funds or ETFs are actually powerful for individual investors, because they allow you with one relatively small amount of money to diversify across a whole bunch of asset classes. So to me, the diversification is both within the asset class, how many securities are within the Aussie equity versus the global equities, etc. And then it's across asset classes, so across property, across fixed income markets, different types, different maturity, different international equity markets, emerging markets. And if you look at, one of the, free pieces of information that people can get is if you look on, the Vanguard website, or you go to any of the big super funds, you can actually see the portfolio asset allocation for the diversified funds. Pretty good way of benchmarking your own portfolio. So, if you look at that and say, well, what have I got? What's your asset allocation? If you look at an SMSF, you typically see, 30% in Aussie equities, maybe 25-30% in cash, chunk in property usually. So does that really, when you balance that up against what Vanguard regards as well diversified, you shouldn't be surprised if you're going to get different performance and risk characteristics, because they're very different portfolios.
That's a good way to do it. A very practical way to do it is to go to the website.
And it's cheap.
Yeah, absolutely. You mentioned it earlier. You talked about the interactive chart on the Vanguard website, and I think it's a great resource. I've used it for years just to go back and look at the performance of different asset classes over a very long period of time. And some of the interesting features are that you can look at different prime ministerships or different political parties, but also different events, so innovations through time. And you still, as always, you see this bottom left to top right. I mean, it's not a straight line, but bottom left to top right, the trend is there for most asset classes. I'm interested, as we come to the end of our discussion, the last 30 years we've seen very good performance, particularly from equity markets in Australia, property markets. Interest rates have fallen during that time. Can passive investing still deliver?
The answer to that is absolutely. I've now been around funds management long enough to, when markets are running really high, people say to me, now's not the time for indexing. I've lived through a GFC, and at the bottom of it, people are saying, well, now's not the time for indexing. Well, my answer is, when is the right time for indexing? And the answer is, it's through all those things. It's just more about how do you build the portfolio. By all means, have some active exposure. Take bets where it actually lines up with your own belief system. But indexing is really saying we're going to try and capture the economic growth of the Australian share market, the US share market, the European share market, the emerging markets. I mean, for Australian investors to be able to very cost effectively, 4 basis points, be able to buy the entire US market. So if suddenly you've got Apple, you've got Microsoft, you've got Alphabet, you've got exposure to all those fantastic sort of technology companies that we don't have in our local market. To be able to do that, I think it's just been terrific from investors' point of view, where they'll be able to bring all that stuff back home and embed it in their portfolio. So I think, that said, our outlook would be that returns, people should have lower expectation of returns than say over the last 30 years. So lower returns sort of for longer because of the sort of economic cycle and market conditions we're experiencing. So I think people need to adjust expectations down. Instead of 8 to 12, 10 to 12% in equity markets, maybe it's more like 6 to 8. And so what does that do to your retirement modelling if you actually factor in the sort of lower return levels? Fixed income, people talk about fixed income, returns are so low, should I have it fixed income? Our view is that, the time you need defensive assets in the portfolio is the time when things are going really, really pear-shaped. And at that point, you want them to be very, very defensive. So the role of fixed income, still has an absolute part to play, we think. And, I think the other part of it is that when markets are bubbling along double-digit returns, if you're paying away 2% in fees, who cares? We're good, we're still making 10%, whatever. If your portfolio is throwing off 5% and you're paying away 2% in fees, that's a massive impact. So low cost matters more in low return environments, I'd argue, than in higher returning markets. So, pay attention to the costs, because it's the one thing you can absolutely control. And if you can get them down, investing, to use Jack Bogle's expression a bit here, is that, it's one of those things that the more you pay, the less you get. So just to keep that in mind in terms of, what are the fundamental things that are actually within each of our control with our own personal portfolios. You can control cost. You never can control performance. You can set it up that you hope it will get a certain level of return and achieve the objectives. But, that's largely up to markets.
Yeah, you use an interesting phrase a few times throughout some of your writing. You've said low cost, high value. And just going back to the interactive chart, I think it's an important disclaimer is realise that you may be looking at a point in time, and we may be at a particular point in time which makes the results slightly skewed. Okay, so last question, Robin, it's my favourite by far, is if you could go back in time and tell a younger you something about money, finance or investing, what would it be?
Simply be buy a broad-based diversified index fund and then get on with your life.
Well, Robin, thanks for joining me on the show. It's been a pleasure.
Thank you. Great to chat.
Thanks again for tuning into the Australian Investors Podcast. For further episodes, head to www.raskfinance.com. To provide feedback, nominate a guest, or hear from me, you can find me on Twitter with the handle @OwenRask. Cheers to our financial futures.